Until today, as you know, we will try to cover lots of different topics in economics and finance. But as we started the new year, we will try to focus on what we will expect in equity market, in our investment, in our cash return, in our equity or stock exchange return or fixed income, what will happen in financial market this year. And this will be our presentation. Please look at the slide first. This is the world equity valuation on the left-hand side, the MSCI, Morgan Stanley's index for the world, not just for region, country. This is world MSCI index for forward PE ratio. Maybe for the newcomer, I will try to define the PE ratio. The PE ratio is price earning ratio. Okay, this means that this price, the P here, is the price of the stock that you hold at your hand today, and the earning is what this company is earned for the next year. Okay, the sales or earnings for the company. And if this price earning ratio is increasing, meaning that your price is higher than your earning and your stock or your investment is expensive. Okay, please keep in mind that if your price earning ratio is increasing, meaning that your company earning is less than the price in the market. So market is mispricing the valuation of your company. For that reason, here, as you see, the price earning ratio is really high, meaning that the stock is expensive. And if you take this company here, meaning that you will lose your money. And for the approximately 30 years, from 1990s till now, the price earning ratio is around 16.3. And today it is just 17, meaning that the price earning ratio is approximately exactly same with the 30 years average. So not expensive, not cheaper. Okay, on the left-hand side, we can directly see that this is our valuation. We have lots of valuation metrics. Okay, price earning ratio, EPS, earning yields, treasury yields. We have lots of different metrics for the company or stock exchange valuation. But one of the best well-known is the price earning ratio. And the price earning ratio, as I say, is a best indicator how you can take position, whether the company or the index is cheaper or expensive. And if the price earning ratio is increasing, you can directly understand, basically, on average, you can directly understand that the company, if it is rising, price earning ratio is rising, your company going to expensive. So if it is less than their average, it is cheaper. On the left-hand side, the graph directly trying to tell us the reality behind the screen. And on the right-hand side, equity and credit yields. Please look at the green line. Look at the definition of the green line, developed market equity earning yield, and global BBB, meaning that investment grade. If it is less than BBB, this credit market is not an investment opportunity. Okay, it is including a high risk behind that. So we are focusing on BBB credit yield and the developed market equity earning yield. What is the difference between this? Equity is a risky asset, meaning that you can earn and you can lose your money. But in the credit yield, if you put your money in credit yield, it will like a cash investment, term deposit. You will get the money. So as you see here, now the developed market equity yield and the global BBB investment grade credit yield is almost same. But let's look at the COVID crisis period. The earning yield in credits is really less than the earning yield in developed market equities, because especially in volatility times, these type of earnings really lose their credibility, especially in investment grade. So today, yes, it is even the blue line, even less than the green, but it is almost same. So today we can say that for the next year, here we have 2024, for the next year, both is decreasing. Okay, both is decreasing, but equity earning is a little bit better expectation. Okay, the credit market investment is less than the equity investment. Why? Because we will decrease the interest rate in the 2024, and decrease in interest rate can increase the investment opportunity in equity market, but the yield curve will be less opportunistic. In the first slide, you will see the MSCI World PE, all countries all around the world. But if we focus on the regional differences in global forward PE ratio, meaning that, yes, we have an MSCI World Index, but we also have the regional indexes. And as you see here, this is world. But the second column for the US. And the third one is Europe excluding the United Kingdom, meaning European Union. And the UK is here. Emerging market is here. And the China is here. What this graph tells us in brief? This graph showing that, please look at the definition here. The black column, the black range is the market price since 1990s. The bottom line is smallest and the upper line is the highest value for the PE ratio. For instance, for the China, please look at the China. The smallest value is approximately 9 and the highest value is approximately 34. But the average, please look at the average. This is the green dashboard. It is approximately just 13. And the current one is the rectangle in blue, meaning that the current PE ratio is less than the average, meaning that the equity market in China is cheaper. Okay, you should understand from this picture directly that if the average line is above the current ratio in the PE, price earning, that market is cheaper. For instance, the world is exactly the same, but US average is here, but the current ratio is here, meaning that US stock market today is expensive. Okay. The Europe is exactly similar to the world. It's almost not cheaper, not expensive, but UK, it is cheaper. Emerging market, cheaper, and the China is cheaper. Okay. So while putting your money in international market, in stock exchange, in equity market, you should also take into consideration that whether this market is cheaper and do you have a possibility to a future earning in this market. For that reason, you should make a categorization and differentiation in different region. Okay, separately take into consideration the region, and you should put your money in the cheaper side rather than the expensive asset. So if you put your money in United States, this means that you can lose your money. But if you put your money in China or the United Kingdom, during 1 year, you will get an earning, at least 1% or 2%. We don't know. But the possibility of earning is higher. But in the United States, you will lose your money. The data is saying this. On the right-hand side, the relative equity valuation, meaning that discount premium based on the 12-month forward PE ratio. And this is a discount ratio. China versus United States is the orange line. This is really, really lower. European Union excluding United Kingdom versus United States, it is the purple line here, minus 30. But UK versus United States is the blue line, meaning that China is really discounted compared to United States, meaning that China is really, really cheaper when we compare it with United States. If we compare European Union with United States, it is cheaper, but not like China. Okay, China is discounted approximately 50 basis points, 50%, but the Europe is just 30%. And the UK is also really cheaper when we compare it with the United States in approximately 45%. So the left-hand side showing what will be the probability of you will earn or lose the money in the world market in different region. And the right-hand side trying to tell you that how the comparable region discounted, meaning that the real value of the asset is $100, the real value, but today the price is 60. So meaning that you know the real value is 100, but today it is sold in just $60. If you take this value asset in $60, meaning that there is a probability this asset will increase from 60 to 100. Okay, this from 100 to 60 is discount ratio. How it is cheaper. Okay, how it is discounted. For that reason, you can earn approximately 50% higher if you put your money China rather than the United States. You can earn 30% if you put your money in Europe stock rather than the United States. If you put your money and investment in United Kingdom, you will earn more than 45% to United States Stock Exchange. The graph trying to tell you this reality. And here in this slide, we are trying to focus on the regional earning expectation and profit margin. PE ratio showing us that this will be the price and the price of the stock, and the earning is how much this company will be earned. But the earning expectation here is directly not the price, but the earning per share, EPS. So as you see here, consensus estimate of on the left-hand side, the chart title is consensus estimate for global earning per share, EPS, this one, okay, earning per share growth. And if you look at the differentiation, earning per share will huge in emerging market, okay, in 2024. Please look at this. Green column is 2024 and the black one is the 2023. So the highest earning per share growth possibility is in emerging market, and the China also really high. But what is the lowest one? Europe. Earning per share is really low because we know that there's a huge probability of the recession in European region because they are the industrial production economy and the interest rate is really high. They are not producing, they are not growing, and earning per share is really low. Growth of earning per share in Europe is really low. And on the right-hand side, the profit margin. Why the profit margin is important for us? One company can produce, one company can be alive. They can proceed their operation in sales as well. But one company should produce profit at the end if you wanna earn money from your investment. Please think this. You have a company in, let's say, Uruguay or Kenya or South Africa. Okay, there is a factory there. They go to the initial public offering in stock exchange and they collect the money and invest it from the stock exchange, from the public. This factory producing every day, but they are not converting their production to the profit. They are losing money. Do you put your money to this factory? No, because you know that they are producing, but they are losing the money. They are net loser. So at the end, this company will go to the bankruptcy. Okay, so our initial focus is directly to get the profit at the end of the year. Cash flow is important also, but the profit to get an earning from your company is one of the best well-known priority while making your investment decision. If you focus on the profit margin here, for the 2024, the United States 12%, this is, please look at the definition. This line showing 12-month trailing earning relative to sales. Okay, earning to sales. And this is directly profit margin. And the United States is approximately 12%. But as you see, Europe and United Kingdom is just 10%, meaning that profit margin will be better in United States, but market priced this. For that reason, United States is expensive. Normally, you should expect that if United States profit margin is higher, why we will not put our money to United States? Because markets see this reality. Okay, markets see this reality. 1 year ago, the United States profit margin will be higher, and they take position in the United States corporation, and they collect the stocks, and stock is today is really higher prices, and they are expensive. For that reason, we should take into position in the cheaper prices like United Kingdom and Europe. In the next slide, we will focus on the global equity market correlation with the treasury yield. Why this is important? We have an equity market. This is a risky asset. And we have treasury yield, non-risky asset. If Dr. Walchin put his money to the Federal Reserve government treasury yield, there is no possibility to lose the money, because Federal Reserve Treasury will persuade the Dr. Walchin at the end of the year for $1 million, they will pay approximately $50,000 without no risk. Okay. Treasury yield meaning this, no risk. So if the treasury yield earning is approximately the same with the equity market, why Dr. Walchin put his money a risky asset? Because at the end of the year, without any risk, he will get 60,000. If equity market expectation is less than 60,000, nobody will put their money in equity market because it is risky. With risk, you will earn 60,000, but without risk in treasury, you will earn also a $60,000. So if equity market will increase their risk appetite, their earning per share or their profit margin or their investment return should be higher than the treasury yield if the people put their money in equity market, right? Because if I put a money in equity market, I'm taking a risk. I'm taking a risk to lose my money as well. So as a risk premium, the return should be higher than a fixed income asset like a treasury yield, because I'm taking a risk. On the left-hand side, you see the value. Value means Amazon, Tesla, Microsoft, meaning that the value of the corporation is really high. But there is growth, meaning that like a startup, there is no value for this company, but there is a huge probability to earn money even 100%. Okay, this is a growth investment, but the value investment like Amazon, Apple, Intel, those are 100 years company, and they are really has a value in the market. And here you will see that Japan, from here to here, you will see that Japan, small capitalized, and UK, Eurozone, emerging market, large capitalized, China and US. And here, the green line showing us that, country and the region. And the large and the small showing us how it is capitalized, low capital market or large capital market. And the blue one is showing the value and the growth. And please look at the definition. Regions styles tending to outperform MSCI when yields are rising, meaning that this arrow showing us that these can be outperformed and these will be underperformed because this is minus. Please look at the numbers here. Okay, I'm here in 0. If it is in the left-hand side, I will lose the money in the next year in growth in US. And here, as you see, if I compare to the treasury yield, not just equity market, but with treasury yield, in this company, in this region, I can earn money correlation, because this is correlation of region with styles to the US 10-year treasury. And on the right-hand side, I'm putting now not the country or region, but the different sectors. Please look at this one. Energy, financial, industrials, materials, utilities, healthcare, consumer staples, consumer discretionary, real estate, information technology, and communication services. These are the different sectors all around the world in MSCI World Index. Okay. And this is showing directly 10-year treasury yield correlation of sector relative performance with 10-year treasury yield. So if sectors tending to this side, this means that they will outperform to the index, and this side will be underperformed to the sector. So if you put your money for the next year, you should focus on this side: materials, industrials, financials, and energy. So this one will be the loser: utilities, healthcare, consumer staple, consumer discretionary, real estate, IT, and communication services. So as the participant, first you should decide which country you will put your money. Okay, world, UK, United States, European Union, China, or emerging market. Then after decide to the region, then you will focus on which sector you will put your money. Okay, so to choose the region or the country is not the end of the duty for you. You should also correctly decide which sector you should put your money. Even you choose correct country, if you choose the incorrect sector, you will lose your money again. Okay, so you will have two priority. First, the region and the country, and the second, you should choose also your sector in that country correctly as well to earn the money. And here, in this slide, we will try to show that global equity sector ratings. Please look at this one. This is United States, the black one. The purple one is the Europe, excluding United Kingdom, today the European Union. The blue is the United Kingdom, and the green is the emerging market. So the highest focus in IT sector. In United States, it's approximately 30% global weights of the sector. But the IT is really low in United Kingdom. What is the highest in United Kingdom? It is approximately in financial and consumer staples, approximately 20%. So the market in the United States focus on IT, while the market in emerging market focus on financials, or in United Kingdom in consumer staples. So you should also look at the market averaging and market converging to which sector is the priority while the investors taking their decision, put their money in the sectors. Okay, these are the sector differentiation with different world region in the equity market. And in the bottom line, MSCI growth and value sector weights. And this black one is the growth sector, and the green line is the value. Please remember this. Value means like the big company, huge company, like Alibaba, like Microsoft, like Amazon, like Tesla, or like Apple. And this growth one, the black one, is like a startup. Okay, these are like a startup in California. So these have huge probability of growth, but the value has a less probability of growth, but they are resilient. They're robust sectors. As you see here, IT has huge probability of growth, but the financial has huge probability of value because banking sector is value producing, but IT sector is growth producing, right? Banking sector has a huge profit, but the profit growth rate is really low in banking sector. And in this slide, we will try to show to our participant that this is the global equity income. What we mean that? Global equity income, this is dividend payout ratio. What we mean by, if any of our participants remember that, what we mean by dividend payout ratio. If you attend our meetings in previous meeting, maybe, I don't know, in previous weeks, you can directly understand that dividend is this. If you put your money in the Apple or Microsoft. Okay, let's say you put your money $1 million to the Microsoft equity today. And next year, Microsoft declared to the market that their market and their company profit is approximately $15 billion. Okay, this is the Microsoft profit. So if Dr. Walchin take a position for $1 million in Microsoft, he is a shareholder, even 0.001% in the Microsoft as a shareholder, right? He is an investor. He has a share in Microsoft, even small percentages. So he has a right to take a profit from the next year overall profit margin. So with his shareholder participation ratio, Dr. Walchin will get, with their $1 million, a dividend. This dividend is the income profit ratio of the Dr. Walchin because he is an investor in Microsoft. This is your dividend in that company. For instance, today, let's say $1 million, then Microsoft decided that they will share and they will distribute their profit 10% to their shareholder, meaning that Dr. Walchin for their $1 million get a dividend payout $100,000 as a dividend. Without the price, without the earning. This is your dividend. You will understand the dividend logic at the end of the slide, how people earn the money, especially from dividend payout ratio. Okay? So think this. You put $1 million and every year company paying you a 100,000 dividend, meaning that 10 years later, you will get your initial investment, $1 million. And if the price is today, let's say 2 times higher, you will earn from this company for your $1 million a $2 million. Okay, because dividend paid during the 10 years for you as your initial investment. And in the slide, as you see, the black one, the dividend payout ratio is really low in United States, the black line. And the Europe, purple one, is the highest dividend payout ratio. United Kingdom is almost same with Europe, the blue line. And the emerging market is low. This is especially common from the profit and dividend distribution logic. On the right-hand side, we have MSCI World Earning and Dividend Drawn, meaning that how the earning drawn during the recession period. Please look at here, dot-com crisis, 2008 global financial crisis, and here we have COVID crisis. During these periods, our earning drawn and dividend drawn as well. Okay, these are showing how our earning and dividend payout ratio is decreasing, especially during this recessionary period in dot-com crisis, global financial crisis, and COVID pandemic crisis. And here we have equity market factors, S&P 500 quality and relative performance with total return index level rebased to 100. This is indexed to 100 in January 1990s, meaning that the value in 1990s is indexed to 100, and today S&P quality is approximately here, 145, meaning that any investor during 30 years get at least 45% from this investment during the 30 years. But this is low, especially in recessionary period. After the recession, as you see, from 140, you are decreasing to 120. Or even in COVID crisis, from 150, you are decreasing 140. And please look at the dot-com crisis, from 120 to the 95, you are decreasing. So this is not a just upward slope equity earning. This is also has a volatility, especially in recessionary period. And on the right-hand side, we have MSCI World Growth and Value Forward PE ratios, meaning that we have today MSCI World Growth and the value Please remember, what is growth? Like a startup, and the value is a big company, and the PE ratio is price earning ratio. And please remember that if the price earning ratio is increasing, and if it is above the average line, this company is expensive. So I will not put any money to those type of investment. And the green line, please look at this one. Green line stable. Please look at this. From 12% to 12%, always stable. Not increasing, not decreasing, because you have a value. You know this company, and this company is producing a value. But in the growth, like an IT sector and startup in California, this is a huge opportunity of increasing. Huge opportunity of increasing to your investment because you are putting your money in growth side. The logic of the equity market valuation for the next couple of years, especially for the 2024, is this. We try to define the equity market valuation expectation for the next year. Now, we will try to focus on the commodity market. What we mean by commodity market? Oil, petroleum, iron ore, aluminum, all those type of things is called as commodity. Okay, not the stocks, not the money, but commodity. Okay, aluminum, palladium, even wheat. Okay, even wheat, even silk, all these type of things, cotton, this is a commodity in the world market. And this is West Texas Texas crude oil. Okay, and we have another one, the Brent oil. If we say VTI, this is West Texas, and if we focus on the Brent, this is European side, Brent petrol. The price is almost similar, and this one is the oil market. Please look at USD per barrel. Okay, barrel price of the oil today on the left hand side, and oil prices is black one, and today it is approximately 79, 75, the oil. Oil increased approximately 120 during the Russian-Ukraine crisis here, okay? And the right-hand side is the number of rigs. And as you see, if the rigs is decreasing, they have a huge correlation with oil rigs and oil production and prices. And if the rigs is increasing, the price is increasing. If the rigs decreasing, price is decreasing. So as you see here, after a huge increase in rigs, we have a huge commodity price update and increase in the oil market. But today, the rigs gradually decreasing and the price is adjusting for that. And the right-hand side, crude oil production by country. And look at this one, the blue one, excluding Saudi Arabia, Iran, and Venezuela, OPEC, oil production exporting countries. Okay, oil, these countries are producing and exporting to oil, but this OPEC, the blue line, is excluding the biggest product producers like Saudi Arabia, Iran, and Venezuela. These are one of the really biggest producer in oil market. And the US is the black, the Russia is green here, and the Saudi Arabia is orange, Iran here in purple, Venezuela in green, and OPEC is here. So the total OPEC, this is million per barrel today, million barrel per day, each day. What million per barrel the world countries and different region producing in oil market? The OPEC is 16 million per barrel, but the United States approximately 13, and the lowest one is Venezuela. But in OPEC, we have lots of countries. For that reason, don't think OPEC just the one country. And the commodity market pricing and the real treasury yield. As you see, if the real US treasury yield versus gold. Gold a commodity. Gold is a commodity, one of the best well-known commodity. And the gold price per ounce, okay, troy ounce, this one is orange. Today's 1 ounce of the gold is approximately $2,100. And the real treasury yield, this is converted. And the black one. So normally, if the treasury yield is increasing, the gold price is increasing. and vice versa. But today, normally here, especially here, the treasury yield decreasing, but the gold price is increasing because of the tapering process in central banks. But the market is adjusting here. The treasury yield reverse and the gold prices started to increase here as well. And on the right-hand side, please look at the different commodities. As I said, commodities like oil, palladium, metals, iron ore, aluminum, also the cotton, wheat, all these type of things, soybean, even soybean is a commodity. So we have index level, the price of index. So crude oil is here. If 2007 is 100, it is just 25% increase approximately in 15 years in the commodity prices, in the crude oil. In the industrial, it is less than, meaning that industrial commodity price is less than 15 years ago's prices. And the agriculture is around just 15 years ago prices. So if you put your money in crude oil during 15 years in commodity market, you earn money. In agriculture, no money. In industrial, you will lose your money during 15 years if you put your money in commodity market. And here we have asset return expectation in 2024. And this is long-term capital market assumption, expected return in coming 10 and 15 years. So not just for the next year, 2024 or 2025. This is approximately for 10 or 15 years projection. What will be the long-term market capital assumption? And the China is the biggest earner. Please look at here. And this will be in equity in China. And the Eurozone large capital is also 8%. China is approximately 9%. But the blue one, fixed income, US investment, corporate investment grade corporation. And these are just 5.5% return in next 10 years or 15 years annual. This is annual, 5% annual return. And the orange one is the alternatives, meaning that I can put my money in equity, I can put my money in fixed income, but alternative investment like cash, like commodity. These are the alternative investment opportunities in UK and global infrastructure, for instance. So if you put your money for your children today, you can choose the China equity market or Eurozone large capital market. But if you want to earn the lowest money, you can put your money in United Kingdom as a cash. Your children will have no money compared to the China children who put their investment for their children in China as a equity market. Okay, so investment is not a game. Investment is a long-term projection. While making decision, you are not trading. You are taking a long-term projection for your investment for 10 years or 15 years. And last two slides, as I said, what is the dividend and why it is important for long-term asset return. Please look at this graph. Let's say Dr. Walchin has just £1. £1, okay? Just £1. £1 in 1990s, okay, or in 900, okay, meaning that 100 years ago. If Dr. Walchin put £1 to equity, it will be approximately 395 pounds. 395 times higher during 100 years. Okay, the period is 100 year, but how much it is larger? 400 times. Meaning like each year it is 4 times higher. Each year you are earning 4 times higher in equities. But in bonds, it is just £4. Like a logic. During 100 years, this is 395 pounds. But in bond fixed income, it is just 400. And in cash, it is just 2 pounds. Just 2 pounds during 100 years from 1 pound to 2 pounds. Nothing. But in equity, if you put your money to equity market, you will be richer 400 times today than your 100 years ago. So investment is a long-term opportunity to earn huge money in capital market. And the last one, also a good representation of what can the long-term investment bring to your opportunities in investment making decision. This graph showing that if you put your money in your 35 age, okay, let's say you have a children, it has an age 25, and if you put your money 5,000 pounds, and if this grow 5% each year, in 55, just your 5,000 will be approximately 700,000. Okay, this is a huge opportunity. Huge opportunity. Meaning that approximately 140 times higher. And if you start your long-term investment in your 35, 10 years later, it will be half of it. Why? Because this 10 years is your initial capital collecting process. So 10 years is important in investment, especially if you start in earlier age. And if you put your 5,000 in an index, okay, Great British Pound stock exchange index, from 30 years later, your 5,000 will be 30,000 if you don't put your dividend to your index, because you have 5,000 and they are paying you 100,000 each year. And if you put your that 100 pound to index again, your money will be approximately here, 4 times higher this. So if you are making investment, if you're putting your money in stock exchange, and if your company paying dividend to you, you should put all your dividend to again that company to earn more money. Okay. If you don't put your money, your income will be 30,000. If you put your money, it will be 125,000. The decision is, if you get profit and if you get dividend from your company, you should put your dividend and shareholder to that